So we're absolutely delighted to have Goran Vasiljevic here with us today. Goran Vasiljevic is the Chief Investment Officer and Speaker of the Management Board at Lingohr and Partner. He is responsible for the strategic direction of the company and the investment strategy. He joined the company in 2011 as Senior Portfolio Manager and worked directly for the company's founder, Frank Lingohr. As his designated successor, he took responsibility for research and product development in 2015 and subsequently for the entire investment strategy. He holds a bachelor's degree in management and finance and a master's in finance from Tulane University. After his studies in 2005, he worked in different positions in equity research, business valuation, and mergers and acquisitions. Thank you for joining us today, Mr. Vasiljevic.
Thank you for having me, and a pleasure to be here.
Excellent. So let's get started with the presentation.
Here we go. Great. Let me just see if I have all the tools. Yes. So I think at this point in time, obviously 2022 has been somewhat of a turning point for lots of value investors. We've seen a tremendous recovery in value investing and more interest again, which after many, many years, almost 1.5 decades, if you want to start look back at 2006 when the value cycle was broken, it feels nice again to be performing extremely well. But we believe at Lingohr Partner, we're very passionate about investors for over 25 years, that value is back and it's here to stay. And that's why we built a presentation with some information about why we think it's going to stay, why we think it's attractive, and why we think the market is overly pessimistic at times when it underperforms and why it shouldn't be. Now, this slide, I've mentioned this before, I've shown it before, unfortunately. And every time I see so many news that value investing is dead, I find it encouraging because a bottom or the top of a trend has been reached. John Templeton words could be taken very solidly in that case, that the maximum pessimism has been reached, or optimism in a different case. Now, we saw up to 2019, and I think this is really important for all investors of all kinds to understand the future is very unpredictable, it's very complex, and we think that in 2019, actually, a lot of growth stocks were overvalued and value was very attractively priced. COVID came in 2020, which caused a lot of technology companies to get a lot of extra spending. Digital spending increased in some nations or some countries, in some regions, it quadrupled. So revenues exploded for a lot of companies. But now slowly we are seeing that, hey, this was a one-time event. This should have been priced, or people were pricing tech companies completely wrong. And as a result, we kind of almost saw a picture we've seen before, but it was more mixed. We saw almost a slight resemblance to the dot-com bubble of 2000 and to the Nifty 50, where quality companies or glamorous stocks have ridiculous multiples because they're priced into perfection for a very, very long, or into perpetuity, which we will show you that only very few companies will ever manage to sustain high margins. Now, to look backwards, and it will help us to understand where we're going, we've analyzed basically what you want to call a value premium or the performance of a value portfolio. We took the global universe of roughly 4,000 stocks. We looked at 5 of the most important value factors, which could be free cash flow, PE, price book. So it's a multi-factor composite of value factors. And we built portfolios with a rebalancing of 6 months. So basically every 6 months you buy the 10% most attractive names based on this multi-factor model. You hold it for 6 months, and after 6 months, you do the same thing again. Now, we show you basically here in the long term, I want to just highlight this with a pen. 1 second, please. That in the long term, the first decile has a tremendous outperformance. It's incredible that with a very simple portfolio, you can outperform the market by roughly 7.5% annualized. Now, what you see, what's also interesting is that going more expensive, so less fundamental value, your performance decreases every single decile. And the most expensive names, so the stocks that have the worst fundamentals in comparison to the price currently, underperform the market by a huge margin. Now, this includes 2020. This includes the last couple of years where the performance has been amazing for these tech companies. Now, we see the last 3 years, so 2018, 19, 20, the most attractive names performed terrible. And it wasn't even just the first decile, but basically everything that was fundamentally attractive performed horrendous. And the most expensive names outperformed the market by roughly 12.5% on an annual basis. So you see that the world, in our opinion, was upside down. This happens very infrequently, but it does happen. 2018, 19, 20 were years like that. 2000 was a year like this. And if you go further back, you always see once in a while, every 10 to 15 years, you see periods where fundamentals play zero importance to investors. Now, on the next page, before starting, this is, I think, important for us to share what do we believe in. And I think when we do research, when we look at single stocks, when we look at portfolios, when we look at quantitative historic research, we like to have core beliefs or things that are important to take into your mindset before analyzing things. Now, the first and foremost is our job as value investors, or any investor's job, is to differentiate between the fundamentals of the company and the implied price, or the expectations implied by the price, the stock market. And this is extremely difficult because people oftentimes think this is a good company, this is a bad company. We don't look at it at all like this. We are general agnostic to any sector or any country, any market cap. We think that if a company's fundamentals are great in comparison to a price, then it could be a good investment. Second, valuation matters. This is a very simple concept. And obviously a PE ratio, for example, it's just one number. It says P of 15 or P of 20 or P of 25. It's obviously in this P ratio, there's so much information which is kind of pressed into one single number. And obviously that's a weakness, but it does have its strength as well. We know it's a fact, if you buy a market or a stock with a low valuation compared to future earnings, then you will outperform the market by a significant margin over long periods of time. Looking at S&P 500, looking at even Apple, if you're buying at a low multiple, it's better than buying a high multiple. Now, there is companies, obviously, fundamentals deteriorate, but on average, it's always better to buy with a low valuation compared to a high valuation. Now, why does this happen, and why can we take advantage of the market's behavior? And we think the main reason for this called value premium, or between values investors, alpha gap, so to speak, is that humans act irrational at times. This is not all the time, but at times. And we see Corona as a perfect example how fast people decided on a very long future. I mean, you're buying an investment based on perpetuity of cash flows in a very complex environment. No one knows what's going to happen, especially 2 years ago with the pandemic. It was very new, it was very fresh. But people decided very quickly who the winners are and who the losers are. Everyone decided Zoom is now 10 times or 5 times more worth than it was before. Now, obviously, it's worth more due to COVID than it was before. It's a huge tailwind for them. However, it's very difficult. Okay, is it sustainable? What will happen? What's the competition? There's so many questions. And I think our emotional construct is we overreact too fast with short-term information and what people call the case rate versus the base rate. We overestimate the company's likelihood of achieving Apple or Amazon's or Microsoft pathway. It's very difficult to achieve what these 3 companies I just mentioned, which is once in a lifetime opportunities. The future is not predictable. This is a very important concept. It's very obviously simple. Obviously, everyone knows that that's the way it is. However, if you're paying a very high multiple, it shows us a very high conviction that your growth or your quality will be sustainable for a very long time. In particular, in industries which are very innovation-driven, cycles have become very short because disruptor can be disruptee and can be disruptor. So it's a cycle that are fast. So it's for us very tricky and very dangerous to pay too high multiple, because the high multiple you have to have high conviction as things will stay for a long time. Past performance is a terrible indicator for future performance, because it's more important, why did something perform well? Yeah? What we saw obviously in the market last 15 years, value underperformed growth. There were periods where growth, especially in 2010-11, growth baskets were very attractively priced. It was a once in a lifetime opportunity from a growth perspective, because you had so many companies that generated strong cash flows and which were very attractively priced. And we missed on this opportunity, frankly, because we stick too long with cyclical companies which didn't generate those high cash flows, didn't generate the growth that was very attractively priced. Now, we know, and everyone knows, there's a huge gap between investors' performance and fund performance. I will get back to it in a few slides again. But past performance is a horrible thing of future performance. We have to be anti-cyclical, because good performance often comes with higher valuation, which means higher expectations. Mean reversion. Now, the last 2 years, 3 years, we've heard this from many clients, we've heard this from lots of investors. Mean reversion doesn't exist. To us, mean reversion is a very complex concept of its investor behavior is mean reverting. Multiples are mean reverting. After a few years of good fundamentals, value stocks become more expensively priced. Growth stocks, after a few years of disappointing, will be have less high multiples, so to speak. So there's mean reverting how you price something. There's mean reverting in behavior. There's mean reverting in margins and growth. So basically, they're called, then big word would be cycles. There are cycles in the market which you can take advantage of if you're anti-cyclical from a personality or investor's perspective. In a nutshell, in the short term, stock markets are driven by uncertainty. The higher the uncertainty, the more valuation mispricings you can take advantage of, just as you saw in COVID. And we're a strong believer in long-term cash flows will determine a company's worth. Now, the last few years, we've seen companies had zero pressure of performing or showing cash flows. That now more and more names like, hey, they're growing, but are they able to generate cash flows? And not proving that they can, some business models. Now, obviously, there's a graph here, which most of you have seen before, but for us, it's important to just touch on it in a few seconds, or a few moments. Now, when stocks, and obviously any stock can be over or undervalued. You see the intrinsic value, which we believe is based on the normalized earnings power of a business. And we believe that when the maximum fear, so when especially Corona, for example, at September, October of 2020, the maximum pessimism where performance was bad, markets were pricing a lot of cyclical companies like they will never make money again, or on a downward spiral. These are the best opportunities, because we've seen in the last decades or centuries that there's continuously overreaction on the downside and continuous overreaction on the upside. Now, there's also value stocks which become overly valued. I mean, in 2007, a lot of value companies which belonged back into the cyclical financial space were overvalued because they performed well. They did huge earnings growth, the globalization, a lot of European companies performed really well. The revenues increased, margins increased, they took up more leverage. The banks, obviously, we know what happened to the GFC crisis. But even those baskets, people can get too optimistic. They suddenly don't look at a normalized earnings part, look at top cycle earnings, and then give a high multiple in the top cycle. And obviously then the downfall, the downside is huge, or very big. And this is what happened to value in 2007. Now, we know now, and if you look at a graph at where Max Greed, any stock that basically was in the ARK Innovation Fund, or most stocks were maximum optimism. There was a good story, everything seemed possible. No one talked about valuation. Everyone just talked about what good businesses there are, how big they will be one day, and not assuming, hey, what happens when the economy recovers? Are we pricing this correctly? Obviously, I think there's a big question how to price these names where it's uncertain what will happen. Now, I would like to get into some more specific data of what we call transition matrix. Now, we talked about this bar chart of performance from a value style. Now, instead of doing it deciles, we now did quintiles. And you see here time frame is a very good value cycle, which was 99 to 2006. This is also the global universe. And what we did here, instead of a 6 months rebalancing, we did the 12 months. So every 12 months, you do a new portfolio and you look at a few things. First, what we see here, the migration table. And let me just take the pen again, 1 second. Q1, this number here is 73%. What does it mean? That means that if you establish a portfolio, the cheapest quintile globally, that 73% will stay in this cheap basket. Meaning if you turn around, 27% will get more expensive. They will transition into Q2 to Q5. So what we know is that the market is pricing it, there's somewhat stickiness to it. There's a lot of value names stay cheap after 12 months, but roughly 30% get more expensive. Now, what's important is that the multiple gets more expensive. This is the migration path here. This movement should be positive for your performance. Obviously, you get more expensive, your earnings deteriorate. But in most cases, it's the market is pricing it more, which is a good performance multiple expansion, so to speak. Now, Q5, the most expensive baskets, the highest growth stock, so to speak. Anytime you get cheaper, it's obviously a bad movement. This is that's our premise as value investors. Now, we plotted the performance, and what we will see here is Q1, 17%, Q5, 15%. So these are the stocks Q1 that were cheap and stayed cheap, 15% Q5 that were expensive and stayed expensive. To make it very simple, we looked at here the performance of the non-movers. And what will you see? Every basket lost money on a relative perspective besides the value basket. So the value stocks, even though they were cheap and probably the expectations of the market were somewhat negative, it didn't hurt the performance because the market was too pessimistic on how to price them. Yeah? So they actually outperformed. You could buy the cheapest and you outperform the market. Very simple. But two important things here, what we just said, the premise, anything that goes this direction is basically getting more expensive. So this path is getting everything more expensive. Everything is green, so huge outperformance. And everything that's below the diagonal line, it's getting cheaper, and that's a bad movement. You see here, anything in this direction is getting cheaper, and that's basically bad movement for performance. And actually, we're completely right with this assumption, because you see that only the first 2 quintiles generated outperformance to the market, and the more expensive you got, the worse you performed. Now, obviously, the best stocks were those that moved because they generated an outperformance of 25% in this time frame, which is a bit tremendous. So, as a value investor, you want to find those which are very attractively priced, and you have margin of safety that even those that stay cheap outperform, but the ones that get more expensive are the best performing stocks. Now, obviously, this was in the value cycle. Value performed extremely well, and value outperformed by 8% the market. Now, we looked also on the 2006 to now cycle, but value underperformed. And interestingly, we can see that the migration, so to speak, went a little bit down. So the stickiness, 70%, was still somewhat there. That most names that were value beginning of the year were value at the end of the year. However, a little bit less than the value cycle before. But the huge difference was, and now we can cut a little bit short just because obviously it's a little bit overwhelming to decide, is that the non-movers suddenly outperformed. Yeah, and this is what happened in this bad value cycle, is that value stocks that stayed, and we know roughly 70% stays cheap, so to speak, they suddenly underperformed the market. And we know that the earnings growth of value as a whole was a little bit less in the cycle. But what was actually worse was that the earnings expectations, the gap between expectations and what was realized was fairly large for value stocks between 2006 and 2020. Between 2000 and 2006, the expectations and the realized growth was very close. So there was actually no negative surprises, so to speak. which is obviously the market does that. The market is overly optimistic, and we always see beginning of the year huge expectations for all stocks, and the earnings revisions are somewhat negative throughout the year. Now, for value stocks, back in the day, it was that they were surprising that the market was too negative. But 2006, 2020 was that value stocks actually gap between expected and realized earnings growth was very bad, and this was probably the main reason why it underperformed. The other reason was the growth was very attractively priced. Now, on the other flip side, and this is what's very interesting, the Q5 stocks, so the most expensive stocks that stayed expensive, which was 81%, they outperformed by a huge margin. So the last decade plus, if you were expensive and you stayed expensive, you just performed amazing and you had multiple expansion for very, very many years. Now, what we now did was we looked at the value performance again for the whole time period, and we also looked for quality baskets. So we looked at the most highest quality names in the universe. And we ranked them just like the value portfolio. We took a multi-factor approach to the quality basket. And we also did the first most attractive 20% and did quintiles. And we looked at the performance. Now, through the last 20 plus years, value performance has been still positive, actually, despite the very negative last couple of years. Over the whole period, you would have outperformed nicely the value portfolio. But the movers, so the outliers, so the stocks get more expensively priced than the performance. The stocks, on average, that stayed cheap underperformed. But we know this was a two-sided coin. There was a period where value stocks that stayed cheap outperformed. There's a period where value stocks that stayed cheap underperformed. Now we can enter, on our belief, a time frame for stocks that, because they're so far away from the average valuation, that there's a good opportunity, even stocks that are attractively priced and stay actively priced will outperform the market significantly. Quality stocks, on the flip side, we see here, quality stocks that are highest quality and stay quality outperform the market. And a quality portfolio would have beaten the market over 20 years by 1%, which is an unusual scenario because usually quality portfolios have the characteristics of having low volatility, but they underperform the market because they're too highly priced. But in this time frame, especially the last 10 years, you see good outperformance by quality stocks. However, it's quite muted over the whole frame. But very interesting for quality stocks. If you are Q1, which is the highest quality basket, and you move into Q2 or Q3, meaning your quality deteriorates, so if you don't hold the stocks that keep the good quality, then you lose performance significantly. So for quality stocks, it's very important that you can pay a good price for them or high multiple, but if once they lose quality, their downside is quite large. And that's why you have the non-movers, the ones that are highest quality, stay quality, good performing, but the ones that lose quality underperform the market significantly. Now, to give you some more data around value, where we stand in a value cycle today, what we like to look at is we look at these baskets, and we have here four different. We have the value basket, we have the growth basket, quality, and the universe. Universe always in a basket, it's just all the stocks that we can find in a large cap global universe. Now, we looked at the multi-factors of value, of growth, of quality, and we just want to look at the current percentile rank of the portfolios. And what we like to look at as investors is have KPIs, so to speak, of how to measure an attractiveness of different styles. Now, the value, it's important to even look at value, even though you're screening for the most attractive names, how attractive is value to its own history. And what we'll see here is the 93rd percentile. That means that only 7% in the last 20 plus years, value was more attractively priced than now. Don't forget, in the last 20 years, there was a few crises, the GFC, tech bubble, 2016, Corona. So if we exclude those tops, you basically now still at a value opportunity, just like in a dot-com crisis. So value is extremely cheap from an absolute perspective. Growth, quality, and the universe are actually trading at fairly high multiples. So if you look at a dispersion between value and growth, because these percentile ranks adjust to its own history, but if you look at dispersion, we are still at a 99, 100 percentile, meaning that the valuation advantage for value portfolio is tremendously large. And when we talked at the beginning of the presentation, our core belief is that valuation is extremely important. The starting point of valuation is extremely important for your expected return. The more attractive you can buy assets, the better for your expected return, assuming the fundamentals stay strong. Now, this is the valuation metrics earnings yield. We also looked at the valuation metrics book yield. You see a similar picture. Book yields are higher today than more historically. This is because the marginals of the value baskets are very high. We'll get to it in a second, but actually value stocks are very profitable at the moment. So the book yields are not on the cheapest because we're not in the bottom of a recession. We already recovered, but growth, quality, and the universe, they're very expensive. So again, if you look at the dispersion from on the book yield basis, you see again, very one-sided picture. Then we're looking at CFRI. This is the cash flow return investment. This metric is from the whole Credit Suisse database, which basically measures how efficiently are management teams investing, how good are the projects, and how much cash can you generate out of your projects. This metric was used back in the day to evaluate CEOs and managers' competencies. And now we can use it also on a company level, how efficient and how profitable is a company with their investments and their projects, so to speak. And we see that value portfolio currently has very strong margins, historically speaking. Growth actually has low margins, and quality, this is something that's also true. Quality baskets where Microsoft or Apple, Louis Vuitton, for example, they're trading, they have very high margins, very high profitability currently, and the universe does too. So we are tending towards the top of a cycle potentially from a margin perspective. But we think that interestingly, value being so attractively priced and being very profitable doesn't give you the right picture unless we're on top of a cycle and market actually seeing a downfall, which we don't think is going to happen. And why don't we think it's happened? Because last thing we like to look at is revisions. So we pay attention to, if you look at the last few earnings seasons, your value basket, are the analysts upgrading or downgrading the EPS forecast for 2021? Now we're hitting 2022 and 2023. And what we see is that growth portfolios through the earnings season are having a lot of downgrades. They're disappointing. Now we know through Corona, people got too optimistic because of tremendous growth. Now there's one tailwind, there was one event, so to speak, is fading away. Now value now was very depressing from an earnings perspective, 2020 in Corona. We knew there was a very strong recovery, and slowly analysts are getting more, companies having more visibility, they're getting more and more positive about the future. So we still see the bar being fairly low, and we see room for improvement, which makes it scary from a performance perspective because the portfolios are so cheap. So last year, our portfolio is at roughly between 25 and 30%, depending on the regional exposure. But none of the performance came based on multiple expansion. Actually, our portfolios got even cheaper in 2021 because it was driven purely by earnings growth. And we look at next year, this year we're growing again, and with upgrades, we're getting even more cheap. So the dispersion is increasing despite values outperformance to other styles. In a nutshell, if we didn't know the last 15 years value underperformed, purely from a fundamental perspective, which investment looks like the more prudent choice? A value basket, which is attractively priced, where fundamentally the earnings are getting better, where the future growth looks good, and where the profitability is decent? Or do you prefer an investment where it's very highly priced, meaning the market already has very high expectations? So what can be the surprise? And we need surprise to outperform. And you can see the revisions actually being negative and the quality not being so good in growth case. So we think it's a one-sided opportunity at this moment in time, which obviously is the best for value investors. Now, we mentioned one of our core beliefs is mean reversion. And we showed you the matrix that there's a value portfolio for performance perspective and transition that lots of value stocks do actually migrate. So the valuation changes. Now we'll take a look at the mean reversion for margin. And I think this is something very interesting and very important, because when you price something very expensively and you have a high conviction that you see for the margin will stay, that it's tricky once it doesn't. Yeah. And what we did here, we looked at only the US universe from 1990 through 2021. And we had roughly 9,200 companies we looked at. And we took CFRI, so basically how profitable are you in your project management, so to speak. And we want to pay attention to the highest quality names. So the names that are very, very profitable, and are they able to sustain this profitability through many years? And we took that 1, 3, 5, 10, and 15 years. Now, not surprising to us, you will see that in this table all the way to the right, CFRI is above 25%. You will see the blue line, a bar, which is roughly 5%, and it deteriorates to 1%. So from 1,330 stocks, or 9,200 stocks, there was only 13 companies that managed to keep very high margins over 15 years. And we will show you some examples. These are not names that most people know. So pricing something very expensive with, hey, things will last forever, has been a very one-sided bet, which means very lucky one. It's very difficult to price something so far into the future. So you basically see that the higher you go this direction from a CFRI, so the higher your quality is, desto more less and less companies manage to hold on to this high margin. If you're able to hold your profitability for many, many years, you will perform very, very strong. But in the moment you lose it, your downside is very high if you were priced high. This is what we've seen also in the market with some quality names happening recently. Important, there's 14%, so roughly 1,300 companies have managed to have really high CFRIs above 20%. And of these 1,300 or 400 companies, only 13 companies managed to keep excess profitability for more than 15 years. If you obviously would have bought, if you had perfect, basically, foresight, if you knew which of these companies would hold on for 15 years, you would have outperformed the market, obviously, by a very significant proportion of roughly 8% on an annualized basis. So you would have performed very good. But obviously, if you bought 14% of the market and only 1% survived, roughly 90% of the companies are not able to keep on this very high margin. Now, to highlight just more the mean reversion effect, the higher your profitability is, so basically 0 to 5 is where most of the market stocks are. The far right, you see the blue bar roughly at 55%. That means after 1 year, 55% lose their status of being top quality. After 2 years, it's roughly 85 to 90%. So after 3 years, sorry, very few companies are able to hold on to the very high margin. And the higher you are from a starting point, the faster you drop on average. And this is obviously for us very interesting, very important to know, because then we know, hey, you should not pay a very high multiple, because what happens if they're not able to sustain it? Now, the best stock in the US universe that we found, it's actually Brown and Brown, which obviously is fantastic because we're presenting today at Brown University. So I was very happy that this was coincidentally happening to me, or to us. This stock is unbelievable, and I have to say since 1990, this stock has made roughly 40,000%. Yeah, it has performed amazingly well. Now, there's two things for the stock that are very unique. First, back in the day when it was tiny, no one knew that it was great because it was trading at multiples of 3 or 4 times earnings. This was in the early 90s. Yeah, so it was very cheap. And then it has, as you can see below the C4I, we're showing the C4I bars. The green line, this is the cost of capital, and you can see the blue lines in far excess every single year of cost of capital. So this business has every year been, since it IPO'd, has been performing amazingly operationally speaking, and also reinvested amazingly. So it was cheap, and it did something only 13 companies in our database managed over this time frame to hold on to an amazing quality and an amazing reinvestment rate. And then, tada, you made 40,000%, and the market probably did 3,000%. Obviously, this is a once-in-a-lifetime opportunity. And just to give you the context, Berkshire Hathaway did roughly 6,000. So you would have beaten Berkshire by roughly 34,000% if you would have invested in this business. Now, we showed you in the Bloomberg, the green line. Yeah, you see the white line is the price, the green is the P multiple. Now, today the business is trading at 32 times earnings. So now the market has realized this business is amazing, so I'm giving it a high multiple. Now we know the future returns will be lower, overall speaking, and also if it loses this high quality status, there is downside. So right now, this won't be an interesting investment to us, but it could be, because obviously if it keeps growing, you will grow into your valuation if it's able to sustain this unbelievable effort of being very high margin. Now, what happens if you buy a name that performs amazing for also 15 years, but then loses its high quality status? Now we're looking at Stericycle. This stock IPO'd and was always high multiple. So it was 30, 40 times earnings shortly after it IPO'd. Tremendous business, huge margin, huge profitability, huge growth. You see revenue, EBIT here growing until 2015, 16 at an amazing pace. But you would have only, quote unquote, returned 4,000% in a shorter time period, but still 4,000%, just because the market knew it's a great business. So amazing performance. Obviously, if you're high quality and you're growing at a minute, you're gonna have amazing performance. But since 2016, the company has lost 50% of the whole performance because growth declined. EBIT and revenue started declining. It lost this high margin status, and now lots of the tremendous outperformance has been eaten up. It was still a good investment, but this shows you how fast, and this is like you lost 50% of the price return, you lose once you are unable to achieve this amazing high quality return. This comes to the bull of our broken dreams. We need to pay attention to, there's always, historically speaking, these names we think are invincible. And obviously the list is far, far larger than this. And we believe in mean reversion because we think businesses, even Peloton or Deutsche Telekom, for example, are businesses that might turn around because obviously there's people are working there, they're working extremely hard, and the mother of invention is necessity. So, there's no question some of these businesses might still turn around, but what these businesses or these funds have in common is extremely good performance and coupled with very high valuations. You don't see big names or tiers when the valuations were very high. Obviously, there's value traps and businesses dying throughout time because they become obsolete or not competitive anymore. But usually speaking, the most innovative companies, the ones that broke or changed the market, which disrupted, there's potential one day they will be disrupted as well. And then they will lose at high multiple. And then you have no downside protection, which is so important in the market. Now, to summarize from more abstract ways, we drew 3 types of stocks. And we want to highlight that all these stocks have different types of uniqueness to them. Now, all the way on the left, this is for us a Brown, Apple, Microsoft, Amazon. These are stocks, the all-stars, the high expectations names that are the intrinsic value is compounding at a tremendous rate. What we've found historically is that these names trade at a premium because the market knows that these businesses are amazing. And there's very few times historically where you can buy these names which are at a discount or at a below intrinsic value. And they have this tremendous pressure of always delivering amazing returns. This red line symbolizes what happens if one day you lose the status of being growing at a tremendous clip or having tremendous profitability. And then the downside is very, very steep if you're a high valuation name. Obviously, in Brown case, for example, the market didn't know it, so you could buy it very attractively. So obviously, return was even greater. If you're able to compound at an amazing rate, time is your friend. So evaluation is not even that important because you will grow into it. Salesforce is an example, which I used to cover as an analyst when I was working in California 15 years ago. And there was a name that was always a high multiple, but the revenue growth has been sustainable. So the KPIs of the business, the fundamentals have been nonstop amazing, and it performed very good. But if you look at the fund of the stock performance, it's not that incredible when you compare it to the revenue growth because it's always been fairly known, quote unquote, that it's a great quality business and it's growing very strongly. And you always pay 10 times sales almost the last 15 years without any breaks in between. So time is your friend, but we have to keep in mind when we're buying businesses that are highly priced, that are where the market expects, where the market knows these are the best businesses, very few make it very long. One day they will mean revert, so to speak, and then there's significant downside. We don't like to buy businesses such as, for example, Amazon or Microsoft, where the story is very open, it's very visible, it's very known. We were invested in Microsoft a couple of years ago when it was trading at almost single-digit PE ratios, when it was very disliked. And then it turned around the business. We got out too early, but we accept that at one point we will get out too early because we don't expect multiple expansion to last forever or to be sustainable. Now, we believe most stocks, what we call the journey stocks, or most stocks mean revert through long time, periods of time, and most stocks actually underperform the market, actually. I think 60 or 70% of all stocks underperform the market, which is kind of like paradox, but that's the way it is, because once they get too expensive, they start underperforming the market, and they obviously dollar weighted are larger when they're expensive, so the performance is more pressure on the overall performance. Now, these stocks, you have to pay attention to valuation, and you have to buy them when they're attractively priced. You have to buy them when the market is pessimistic. You have to buy them when we were from an anti-cyclical perspective and things have gone wrong. So Corona was a perfect entry point for lots of value investors because the market was pricing a lot of high quality cyclical companies as to there was no recovery in sight for many, many years to come. And what's interesting is of recoveries is that good years and bad years, once they're gone, then they shouldn't be part of the valuation anymore, because how are you going to price them? If 2020 was a bad year for stocks, now in 2022, we don't care that 2020 was a bad year. We're making profitability now, we're making earnings, we're paying dividends. So once you survive the bottom, you have an uptick in the earnings power and you have an uptick in the valuation. And if both move simultaneously, which we have not experienced recently, so we have no multiple expansion, we have just earnings growth, then you obviously have the opportunity for amazing performance. But you have to be aware of market dynamics, of competition, but also where are we in a cycle, which is very difficult. But we try to focus on these types of stocks to try to buy stocks significantly below intrinsic value. Now, falling darlings, obviously in crises, this is how the market prices most stocks in the market that are economically or cyclical companies, basically that the earnings will deteriorate forever. But we've seen many more stocks actually don't deteriorate forever. There's many more stocks make it back to the journey stock level where the earnings are growing at a decent rate compared to the market. And we see these types of stocks, you have to be very careful getting into names where intrinsic value is currently decreasing, so to speak, the value traps. Operating leverage, financial leverage become increasingly more important because these stocks need time to fix their business or need time for the earnings to recover from an economic perspective. But you have to give yourself the chance to have time. So if you buy these stocks with high leverage, for example, or with issues from a governance perspective, you might have no time to allow for the mean reversion to take place. Obviously, if you buy stocks that are priced with such negativity and they turn out to be like some value stocks are, these are the value stocks that are migrating, then you have the most outperformance. These are the movers that become from very cheap to medium valuations that go from P ratio from, so to speak, 7 to 12. These that have obviously have earnings recovering and you have multiple expansion. Now, I took some notes from Howard Marks's most recent book. I know he's been a speaker here, but I really like reading his stuff, and I've been reading his stuff for the last 15 plus years. And I took, from this last book, Getting the Odds on Your Side, or the cycle book, some interesting quotes, and I used it just from a value perspective or from a stock perspective or from an asset allocator perspective. How do you see the bottom of a cycle or top of a cycle? And I really like these because we saw the last 2-3 years how incredible they are. When growth was performing, when Corona was happening, how the investor optimism was so incredibly strong, and talking to clients, hey, valuation doesn't matter anymore. A lot of clients said, hey, don't you have to buy also these tech stocks because cyclical stocks just are not any important anymore. And we stayed our course, we stayed by our conviction. We told them, hey, you have to be anti-cyclical. When people are selling, it's a good time to buy on a midterm cycle. And I really like these notes from him that on the when are your odds in your favor? The odds in your favor when fear is very high, because when fear is high, we become irrational. When the last couple of years has been a poor market performance, we tend to find more negative arguments than positive. And when there's excess risk aversion, which obviously is shown by how something is priced from multiple perspectives, then it's probably a good time to buy. Now, when it's a bad time to buy is when everyone is making money. If it's very easy to make money, everyone makes money in a bull market. And when valuation continuously becomes less and less important, and you see on CNBC, you see in the TV, overall speaking on Bloomberg, that throughout a bull market, valuation or what is the company worth becomes not part of a discussion anymore. We talk about where the stock price should be, but we don't talk about if a multiple is justifying this. We don't talk about someone that would be willing to buy at this price. We're just talking, hey, it keeps going up. And the arguments why are driven by because it's been performing, because it's been going up. We believe, just like when you're evaluating a stock, you should evaluate your investment allocation through KPIs. How do you determine for you or anyone? Everyone has to find for themselves. For us, we set our core beliefs. These are some part of our KPIs, so to speak. And ask yourself, when you're investing today, what is the starting point of today? What is more important, how something performed or will perform? We know for a fact, Morningstar studies show you that 5-star rating of funds will underperform 1-star ratings when you look at a 3-year window. And there is a nice book called Quantitative Value, which has a nice chapter called Paradox of Dumb Money, where it gives you fantastic examples how the best performing funds in the US have the worst investor performance, because investors typically buy those funds after they were good, not before they will be good. So knowing there's obviously value right now would be a perfect time to shift into it with some parts of the allocation. Now, also asking what is driving stock returns? Is it multiple expansion or compression? Because we know this can't go on forever. So things can't get more and more and more expensive. Obviously, we saw that things got more expensive than we thought on the growth side, and values get more attractively priced than we thought, given the context of interest rates today. But obviously, this is there is an end. There is basically light at the tunnel at one point, which you can take advantage of. You should know, or you should have an understanding, why is something mispriced? Why are people so in favor of growth or against value? Obviously, they're against value because there's uncertainty. They're against value because the performance has not been good, that your neighbor doesn't have a value portfolio, typically speaking. Currently, in a couple of years after value performed, they will have it again. And this is, I think, a few questions which every investor should ask himself. Now, to summarize, the times they are changing. Not a great song, but I think this is the accurate statement for where we are right now. We believe in a 3-5 year time frame from now, I wish we had a time capsule, we will see that value has come back very strongly with today's information. Obviously, things can happen that we don't know about, but as of today, value is the bifurcation of valuation between value and growth. Value is still valued extremely attractive. There's so many incredibly mispriced opportunities on a global perspective, especially in Europe and emerging market where the valuation dispersion is the highest. The growth outlook and the earnings seasons, the last 3 earnings seasons for our portfolio, but for value portfolios in general, has been better than the growth or the benchmarks. So there's more stocks beating expectations and raising expectations, which has not been reflected in the multiple so far. So you have fundamentally, there's so-called fundamental momentum, what we want to call it. Fundamentals are improving, which obviously should be warranted. We know from a fact that historically speaking, when there's years of bad performance, it takes some time for the market to change its stance on something. So we accept it. And the better the fundamentals are and the more they can beat, the faster it will come. And now, business macro cycle, raising inflation, obviously are very hot topics. We're not a huge fan of it because we believe it's more important to know what is actually priced in than what is expected by the market, because we can see, even from a GDP perspective, if you would buy the countries with the highest GDP expectations, you would underperform the market because the market tends to price that in already. So it's more important to buy those companies that surprise positively on the GDP and even outperform better, which obviously is very difficult to know which will surprise. Now, but that said, obviously the way the interest rates are moving, a headwind will become a tailwind, and inflation is better for value stocks and water styles on average basis. So we think our KPIs to evaluate an investment style are all trending towards value, and we're very, very confident this will be an amazing period for us if things continue to develop as they are. And with that, a disclaimer. So I'm finished with my presentation.
Excellent. Thank you so much. That was a really, really great presentation and very educational and informational. Excellent. So let's dive into the questions. So our first question is, how do you mitigate behavioral psychology biases such as loss aversion and confirmation bias in your investment process?
Us as value investors, I think this is what we profit from. This is what we take advantage from. So we've developed a very systematic approach to investing. So we look at, historically speaking, which fundamental indicators give you the best potential to have a mispricing, and we screen globally companies based on these characteristics. You know, some call them factors, we call them characteristics of companies. And based on these characteristics, then we, as a big team of the 7 portfolio managers, we look then at these basically filtered names, and we try to only basically look within this pool of stocks which are systematically, fundamentally speaking, very attractively priced to fundamentals. So we don't allow ourselves to look beyond those stocks which are very attractively priced from a fundamental perspective. And we also have strict, so to speak, buy rules, and we also have strict sell rules. So once the stock fundamentally deteriorates, which inversely means the market was right with its cheap valuation, then we will sell it because the score deteriorates, and we will sell it. We want to avoid falling in love with names. It's very important to us. So we have strict buy rules, which are very fundamentally driven. We have strict sell rules to avoid falling in love with it, because as a value investor, you tend to fall in love with your stocks. You always can argue to rebuy once it gets cheaper. It's the typical argument of value investors: oh, it's getting more attractive, I want to buy more. But you want to protect yourself. Once your business KPIs are getting worse, you want to get out of the name.
Yeah, absolutely. That makes a lot of sense. And one of your past holdings was Qurate Retail. Can you discuss what your thesis was on that at the time?
So, basically, I would have to ask the consumer discretionary expert, because we have split a team and sector specialists, so to speak. But obviously, the first and foremost is that it qualified back in the day. When it qualified, the fundamentals of the stock were so attractive given the current price that the portfolio manager or the sector specialist looked at it and then decide, okay, is there a negative, because of portfolio manager view is called negative selection. Are there reasons for me to see that this is a value trap, or that the market is pricing it correctly, so to speak? It's attractive, but it's cheap for a reason, so to speak. And the portfolio manager obviously found it not to be the case. But obviously, we have a portfolio of roughly 300 names, so we try to tend to be far away from a perspective from single stock names, because we want to avoid falling in love. We wanted the fundamentals of each stock. We equal weight our portfolio, so we want to give each name opportunity to outperform.
So talking about that portfolio as a whole, how do you think about diversification, position sizing?
We equal weight. So we have a global portfolio. We have obviously a systematic approach, which makes it repeatable, and it makes it our ability to have a global portfolio. We have European, we have Asian, we have emerging market, and we do it for large cap and for small cap. So this approach, in our opinion, works for basically any scope. Obviously, there's differences between emerging market and a European portfolio from certain processes and certain characteristics which are more important in emerging market versus in Europe or in Japan in particular, which obviously is also a different animal altogether from a fundamental perspective, because the shareholder friendliness is different, and we have to pay more attention to how the companies from corporate governance and from a shareholder friendliness, how it's buying back and dividend payments. However, we treat basically every stock, we give the equal chance. So we equal weight stocks across the globe. If you have a global portfolio, we think that the best chance is to always try to buy a company which is mispriced fundamentally. We have sector specialists, and our models pay attention to sector differences, but we still equal weight every single stock.
And you just spoke about Japan. We're seeing now with some more of these very large companies there, they are doing some more spin-offs to unlock some shareholder value. That's something that you didn't really see in the past. Do you think this is going to continue, and there will, let's say in a decade, be better capital allocation policies and more of a shareholder focus?
We definitely hope so. I think Japan has been our most disappointing region the last couple of years. It's been, historically speaking, one of our best. We've generated significant alpha in Japan. It's been a very good value market up to a couple of years ago. And it was interesting, it's a good also case study, because obviously with not being in an inflation period, the opposite, but value still worked, it kind of defeats the argument that value only works in inflationary periods. So Japan is the opposite example. But now in Japan, obviously you have a different animal, with corporate governance, shareholder friendliness is different. We think we see improvement. We see there's obviously lots of room. If you look at the capital allocation, from how much is going to buybacks, how much is going to R&D, how much is going to dividends, obviously the balance sheets are amazingly positioned. If you look at the US, are very leveraged at the moment, and there's a lot of money going to buybacks and dividends, but there's no room for improvement. Japan is at a very low level, and it keeps getting better. So we would like to see bigger steps. We would like to see more buybacks, so the earnings or cash flow yields get even more attractive, which is important to us. We're very cash flow focused as when we look at fundamentals. Our main factors or characteristics are cash flow driven. And we see there's much in small cap and large cap, much opportunity in Japan.
Yeah, I think that makes a lot of sense. How fundamental of a role do screeners play in your research process? Quantitative screeners or keyword screeners?
So this is basically the biggest part that we consider as pioneers of systematic value investing. I mean, we've been doing it for 25 years plus. We've done tremendous amount of research, and I'm going to say that 10 years ago, when factor investing was in its teenage years, now it's getting more mature, and we've done also a fair share of mistakes. What makes unique to us when we analyze models, we look very little on performance. Performance is a very small part of our research process. We focus on how the characteristics are of this portfolios we are buying with our screeners. We're looking at how the portfolios develop fundamentally. Are we able to buy attractive names where the cash flows are sustainable? Are the cash flows improving? So we're using this transition matrix. We can basically look at anything. We can look at revenues, growth, buybacks, and how it changes throughout time. This is what's important to us. Important is from our approach, we have 4 different models globally. We have one financial model, we have one REITs model, we have one cyclical model, and we have one defensive model. And within this defensive model, for example, we will pay attention also to business models which have reoccurring revenue streams. We also have special adjustments there, so to speak. And defensive, it's hand selected. So basically, there is names that are not typically belong to defensive sector, but if they have reoccurring revenue streams, we have to determine them defensive, because obviously the characteristics having high visibility of recurring revenue makes them defensive. So we've seen that these 4 buckets make sense to have different screeners, because different characteristics are more important for banks or for cyclicals or for defensive stocks. And then we look top down, how attractive are those 4 segments to its own history? How do the KPIs look, which we've talked about a lot today? Is the valuation, how's the dispersion, how's the growth? And then we allocate between these 4 segments to also get some sort of active allocation. And currently, we see financials and cyclical companies as very attractive on a global basis.
It makes a lot of sense. And so what is your framework for analyzing, let's say, I saw that you have a lot of exposure to European banks, for example. So what's your framework for analyzing some of these European banks?
First, the first step is that we call it Chico, we give it a name, which stands for cash in, cash out. Our founder, Frank Lingohr, gave it a name, and he thought it was pretty catchy and stuck with us. And this Chico, so to speak, for financials, will look at the most attractive 10 up to 20%, given how attractive we find financials on a global basis. So we will allow currently we allow the top 15% globally of financials to qualify. Now, we like to have global screens because we found that if you're having a global portfolio or a European portfolio, the European client, but the European companies should still compete with the US companies, fundamentally speaking, so we get the best of the best, so to speak. Now, in the financial model, I think the important facets are earnings momentum, the revisions positive or trending positive or negative. I don't like price momentum as much. I like earnings momentum, fundamental momentum. We look at valuation factors, which are the most important for banks. Obviously, price book, there's price tangible book, there's earnings yield. So you have to decide, hey, which are the earnings, which symbolize valuation the best from an earnings perspective for banks, what is the most important criteria. And we also look at some quality measures. So that's nice. And this screening is then utilized. And then obviously we have a financial expert that looks at the first 15% in Europe that qualifies, or globally, but then we look at the ones that in Europe qualify. And then we have what we called the 5-box system in place. So we have a negative selection, but it's also the process is very, very data driven. So each stock has these 5 boxes that has to basically get approved. The first box is that because we have very data driven, that the data gets checked with 2 different sources to make sure the fundamental data is actually accurate, why it's so cheap. The second box is there any fundamental indicators which are not trustworthy, or maybe potentially there's one-time events? For example, if the earnings for a bank were last year amazing because of trading, and the bank is telling you today, hey, next year won't be as good because we traded a tremendous amount in Q3, but it will not be sustainable, then we know that it's qualifying based on an earnings level which is not sustainable. So basically then the portfolio would negative select it, but hey, I can't buy it because the P/E ratio of 8 is not accurate. The third box will be to look at if the signals across the board holistically make sense. So basically, if the valuation is very low, you would expect the quality to be not perfect. Now, if a name qualifies and the indicators are looking very unaligned, we'll question and look a little bit deeper what's happening. The fourth box is valuation, because we have a sector specialist, you know what the sector should be priced in. So we look at, okay, how is the valuation to its own history? How is the valuation to if it's an insurance company, to other insurance companies, or how is it to other banks? How does it compare to the banks? Which are the best peers? And the fifth box would be corporate governance / ESG and value trap. Are there any risk factors that we see? Is the bank leveraged? Is the business model are revenues deteriorating? Are earnings deteriorating? Are there corporate governance issues? Are there litigation outstanding? And then based on this 5-box system, each single stock has to go through this 5-box system. It gets a negative. Basically, if there's too many indicators which are not correct, then it will be negative selected, because the selection the system does, the portfolio managers make sure there's no blind spots. And the amazing or the cool thing is of us that each single stock with the 5 boxes, we keep track in which box the stock gets thrown out. And if too many stocks, for example, will be in box 2, which is one-time events, then we will look, hey, can we find maybe a better indicator that maybe we have to do an adjusted P/E ratio because we're having too many stocks qualify based on one-time events. So that's to throw out too many stocks. So we can improve. We're giving feedback to the research team to develop better models. That's why we are trying to keep it very process-driven.
Yeah, I think that makes a lot of sense. And can you speak a little bit about how you analyze management, please?
Sorry?
How you analyze management.
Management teams? I mean, we use the whole database of management teams. This is the one number we've told you about, the CFRI number, the cash flow return on investment. We don't talk to management teams. Our founder, Frank Lingohr, always said that CEOs are the best salespeople in the room. We don't want to be biased by charismatic salespeople. I used to be an analyst covering software back in the day when I was living in California. I also spent a lot of time on the road with CEOs. I know how good they're at pitching. And if you take 10 CEOs of 10 car companies, you will see in aggregate they're selling many more cars than the whole market is there to give you as a market share. So we stay away from teams. We want to be systematic. We want to be sure that there's no behavioral, that be objective. So we use the whole framework. We look at the CFRIs. How profitable are they investing in a business? And how is the capital allocation? And are they able to sustain a level of profitability? And we think it's a great metric. The metrics was invented to basically judge CEOs or managers back in the day, and we use it for the same purpose. Hey, is the business run well? Is there improvement? And if you're buying a bank and we see, for example, that there's different banks operating higher margins, what does the bank have to do? Is it doing the right steps? So there's basically, this is our tool, but very data-driven. We don't like to talk to teams. Corporate governance also, I mean, ESG, I mean, corporate governance issue, we will definitely look at scores from diversification from the board and so forth. We obviously think this is a very good thing that has taken place from a governance perspective, and we see governance as the biggest mover because it has the most, from a long values investors perspective. We think governance is the most important driver of a business. If the governing body is correct in place, we think the sustainability of cash flows will be achieved most likely.
Really, that makes a lot of sense. And what are your thoughts on how important an MBA or a CFA is within investing, specifically within value investing?
Currently, we have it. One of my team members just recently passed his CFA, and he studied very hard. I think that it's not a prerequisite. I also think, if I'm really honest, I think an entrepreneur or someone that starts a business of 18 and learns about how to run a business and then understands emotional intelligence or behavioral concepts and can work a little bit of numbers and is anti-cyclical, it's more important than having a CFA or an MBA. I think that you have to be able to, everyone that starts here, one question gets asked is, hey, do you have a thick skin? You know, Seth Klarman said, you don't become a value investor for group hugs. And I think we've learned the last couple of years, and I've been screamed at, I've been yelled at, I've been insulted. I've been called many bad things, and now, you know, things are turning, and I feel, you know, it's been tough. Yeah? And Cliff Asner said that, you know, the value underperformance was like drinking acid, and that's how it did feel like. Hey, we're performing so poorly. What are we doing wrong? Analyzing, and hey, the fundamentals are great, but the market's not pricing it correctly. It's very tough to be a value investor. It's, everyone talks about it, but it's very tough to stay the course. We're one of the very few in Germany that have stayed the course. Valuation, we're very attractively priced, but we're not buying garbage companies, we're buying well-run businesses for very attractive multiples. We have never seen such valuation advantages, but it's very hard to do so. And I think the most important requisite is passion, curiosity, and to be able to be anti-cyclical as a person, to be stand against the herd and not to fall over, because it's very easy to fall over. Things, when they go well for the market or against you, people have very good arguments, because the biggest trump is always that it's performing well. And, you know, a CFA or an MBA will not protect you if you're then changing sides frequently. I think this is the flip-flopping is the worst you can do.
Yeah, absolutely. That makes a lot of sense. And overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
I think there's an amazing book by Jonathan Tepper, I think, about moats, or about these huge super businesses. I think it's a very complex thing. I think there is no right or wrong answer to that. One thing I like to tell people is that in 1992, there was a New York Post article about Microsoft. It's titled "When Junior Got Too Big." Forrester research back then said that Microsoft has been too big, that it's saturated. It had a market cap, I think, of 12 billion. So now it's trading at 2 trillion. And Forrester research said these amazingly smart people. Yeah. And so no one knows how things will transpire. Yeah? I think that the US with regulation has not done an amazing job to protect small businesses. I think that the huge businesses, there will be tailwind and there will be headwind now. I mean, the US has been created because of the monopoly. I mean, because of the Oil Standard Company and the Boston Tea Party, because of raising taxes. And then in history, this happens all the time. And businesses get too powerful, and then they get regulated and get broken up. So I think that some businesses have had much tailwind. They've been done amazing. I mean, Apple, Amazon, Microsoft, amazing performance. I mean, just tremendous business models. But obviously, I think that regulation helped them. Deregulated basically those markets. The regulated financial market, which obviously in hindsight didn't help too much, or has been causing maybe them to try different ways to make money, which they shouldn't have. So short answer, or I'm trying to be more concise. I think the future is very complex. I think there are some businesses which are, I want to believe, that are not super competitive, where I think moats can be held on. I think very innovative sectors, I think disruption will be very, very fast and can happen because of the global scale, because it's so quote unquote cheap to become global. It's become more scary that even if you have global scale, if there's a better product, you can get global very fast, and you just need very smart people, and there's a lot of, and it's also, there's more smart people now than ever before, and it's a global game. So I'll be very tentative to buy moat businesses at a very high valuation. And I also like growth investors. I like even day traders. I have a lot of appreciation to anyone that has a thought out process and the one that sticks to his process. That doesn't mean that you're evolving. I think all investors evolve. We have evolved from a global screen to sectors or segments. So we've improving also constantly and having sector specialists now. So I think I like investor processes. I like investors that can show their somewhat the repeatability in their skill set. I like investors that read a lot, that improve a lot, but still stick to their fundamentals, to their basics. And this is for us. We will not sell something because the market is telling us, because we're underperforming. We will sell something because it's fundamentally getting expensive. And this is, I think, across the board. It doesn't, because it's a global game, there is no difference between any type of region from investors or characteristics or gender. I think it's all the same. I think each one has the ability to have great characteristics to be a great investor. That's what makes it so interesting.
Yeah, that makes a lot of sense. And we spoke earlier about investing in Japan. What are your views on investing in China and Hong Kong and some of the political risks there?
I think anything where the market is uncertain and the valuation is low is fantastic for investing in the mid to long term. I think the valuations are extremely low. China is an amazing market for their investors, because investors that invest in China, historically speaking, and that's why the value premium is very high in China. Historically speaking, in emerging market also, people invest in emerging markets, it's high growth, but they expect very fast, high returns, but they're paying a premium multiple for these high growth names, because the high growth names, a lot of people already know which one is growing high. The scary thing is that there's so many value names trading in very low multiples, but you have such good economic growth that your top line is growing and you're paying very low multiples. And if you stick to the more boring names in these countries, you have a tremendous outperformance, because this GDP growth is fantastic. So the revenue is growing and the business is growing and the population is growing. So you have a lot of tailwind happening, but you're paying low multiples. In the region as a whole, people get very optimistic on it too fast, and then they run out of it. And I think every time they run out of it, you can buy it, because fundamentally speaking, the economy and the businesses are positioned really well. I would stay away from the high innovation names, in my perspective. I would stay to the fundamentally give yourself time and rebuy those valuation and strong earnings companies. And I think emerging market in particular is a very interesting space to be in from the mid to long-term perspective.
I think that makes a lot of sense. And how did you initially become interested in investing, and particularly in value investing?
I was very fortunate that, I went to university in Tulane, and I had some amazing professors that, I read some very interesting books about investing, and kind of captured me. I was not the best student, I have to admit, but once I started reading the stories about other investors and had some sort of mentors, I thought also the case studies valuing a company. I thought it was always very interesting. There's so many facets to it. It's very complex, and I think there's a science part to it, but there's an art part to it, and also to mold it into a process. I think is so fantastic. And I started my career at the perfect spot at a small valuation firm in California. And one of the projects we did, we basically did an M&A advisory job for a company Buffett was buying. And we were basically on the other side of the deal. I never met Buffett or any deals, but preparing for the deal, doing the analysis, my boss told me back then, hey, Buffett is buying a company. He probably was going to give us a low value because he's a value investor. Let's prepare. Let's read his essays. Yeah. And I was like, oh, I don't have to. I read one book in college. And then, a day later, I had like 20 years of essays on my desk. And I started reading his essays, and I got fascinated by his approach or his views on things. I very fast found I had my own view, my different view, but this kind of like was so exciting, be hands-on, and he paid a very high multiple for this business. I was like, wow, I would not pay this. But he was right, because when I read his shareholder letters, this business now has much more cash flow than he paid back then. So I got very lucky. And this kind of since then, I was like, okay, this is what I want to do, and become passionate. And when you're passionate, you read a lot and you learn a lot. And this is what's so great about industry. The information is out there for everyone to get.
Yeah, absolutely. And what is, let's say, a very successful past investment you've made that turned out really well, and also one that didn't turn out so well? And sort of how did you find about each of these companies, and what was your thesis for the investments?
I think one of my best investments was or is on a personal note or on a fund note. I mean, on a personal note, I want to say, which is more interesting, is I bought Bank of America in the global financial crisis in March of 2009. So by pure chance, I bottom fished, and my anti-cyclical nature allowed me to go into the market at the right time. And to this day, I still own it because fundamentally it's recovered and then was attractively priced, and now it's getting the environment better and better. So I think my thesis back then was, hey, I'm betting against that it will go under, like Lehman did. And this obviously is not a fundamental sound case. It was more of a bet than investment. My second investment, very similar time frame, was Apple. I still own Apple to this date, which obviously in our fund we cannot hold right now because it's a little bit too overpriced from a multiple perspective, and too much performance has been driven multiple expansion. But I think as a personal investor to some names, and obviously most of my money is now in funds, but I think Charlie Munger said selling a business sometimes is you holding onto a business which is illogical, even though it's getting too expensive. And I agree, it's very difficult sometimes to sell names which you've been holding for a real long time. But I think as valuation extends, I think you want to be careful to take some parts. And I think the case of Apple was a business model which obviously captures the clients. And I felt that the global vision back then, as a US, living in the US, and then looking at Europe and looking in Asia and traveling quite a bit, seeing the potential back then, I think that was my investment case. Hey, the globalization of this product being so much better from in this luxury segment could be huge. Obviously, never expected to see what happened by any means. Now, for our funds, I think because it's very systematic, we don't fall in love with stocks. I think the best names are very typical. Anytime there's a huge dip, we go into what is most hated. So in 2009, global financial crisis, we bought banks, we bought materials, because in a recession, cyclical stocks perform best. But it's not one single one. I think it's the basket of stocks, because we have 300 stocks. Now, in the last 12 months, we've been outperforming also by a significant margin. Also, this year we've been outperforming. We can see it's steel companies, it's oil companies, it's financials. We're always buying those investments where the market is saying they will never make money again. We go into them because we're like, hey, when we look at normalized mid-cycle earnings, there's tremendous upside. And this is, I think, the best investments we can do, where's the biggest alpha potential. Worst investments, I think worst investments have been where I didn't pay attention to the governance of businesses, where I didn't pay attention to what happens, incentive structures and governance structures. I felt that these are the biggest issues for business when it's run poorly. How can the owners help, or the shareholders, to get maybe better management team in place? And I found this is also maybe that's what as activist managers, obviously, that there's one space of area which is very inefficient to this day, in particular in Europe, where we have to pay more attention to management teams and how they're performing, how they're evaluating, because obviously the compensations are ridiculously high for these businesses, for a lot of businesses, where the performance is very skewed. So I think this is where I think a lot of my bad investments have been on that front. And I think otherwise, if you're having a good business, you can hold on to it, but once it deteriorates fundamentally, I will sell it. So once the KPIs get worse, or if it's not growing as much, if it's a performer, I will sell the business and try to stay very strict there as well.
Absolutely, that makes a lot of sense. And what's your typical holding period for an investment?
We hold at Lingohr Partner, we hold roughly 600 days. But we have names which we hold over for 10 years, if it stays in a very attractive basket. But we also have names that we hold for maybe a year. But on average, 300 names, it's roughly 600 days.
Absolutely. And what are some of the long-term economic impacts that you see resulting from COVID?
Obviously, I think the biggest one is that spending for digitalization has been increased by huge amounts, and obviously probably necessary investments. And we've noticed that we can work from home just as easily. So I think the long-term impacts are real estate, office space, and of digitalization spending, how much digitalization or technology can help us work and live comfortably. On the flip side, obviously, once we can obviously put COVID past behind us and hopefully be close to it, how people will behave then, and if they're going to go back to the office and they're going to work again in the office, and we will see what will happen. I mean, obviously we're very resilient as human beings, and it will be very exciting to see.
Yeah, absolutely. And what is your advice for students who dream of interning at Lingohr and Partner?
Reach out to us. I think we are the one William, for example, that just the CFA, which I mentioned, he interned with us and we hired him. I think it's always a pleasure to have people on board and meet people. And anytime someone is interested with the value investing in particular, I think it's a huge plus. Huge. We feel very humbled when people approach us. I think it's still, to me, I know that I've been in the business for some years now, but I think it's amazing to see young talent which are passionate about value investing, in particular in this time of age, because with cryptocurrency, with digitalization, there's obviously more attractive pockets happening, but these are basic old tool sets, which obviously I think is still today as much needed as ever before.
Yeah, absolutely. That's terrific. Thank you. And for a concluding question, what have been the most influential events of your investing career?
Sorry?
The most influential events of your investing career.
That's a good one. I think one, I moved to Germany back in 2010 and I applied to Lingohr Partner, and Lingohr Partner, we were back then, I think, probably the most, well, probably the biggest value house in Germany, and also globally we were extremely recognized. Our founder, Frank Lingohr, he's also in the book Great Minds of Investing. Lingohr is a very international name. We had clients all over the world, and I applied to them. I wrote Mr. Lingohr a letter, and he actually read it. He invited me, and I met him. And the interview started with Mr. Vasiljevic. We don't have an open position, but I wanted to know you because the letter was so nice. And he actually hired me on the spot 30 minutes later, which was obviously kind of a very ridiculous experience, because I was used to in the US having 5-6 rounds of interviews. And the funny thing was, a mother-in-law, she called me because I've been looking for my next move. I'm passionate. I've been dreaming about joining a great value team. And then even that he called me like, hey, please come in, was already, and she called me and she's like, hey, I think you're gonna get a job today. And I was like, hey, it's gonna take a couple of rounds. And then half an hour later I had a job, and I didn't even know what he offered me. I just said yes. So that was obviously a crazy experience to me. And then I want to say Brexit and Corona, and also this value underperformance, that it doesn't matter how much research you do and how much you prepare, things will happen that you didn't prepare for, and you will look like, quote unquote, an idiot in the market if you took a very active position. And as a value investor, which is benchmark agnostic, we are very active. Our active share is always 95% plus. So we're very far away from the benchmark. And even if you, from a probability perspective, an analytic perspective, you did everything right, you can be wrong sometimes. In football, coaches make wrong decisions but still win the game. This happens all the time. And we learned that even our process was good, a lot of times we underperformed, and everyone tell you are bad. I think to stick to it through Brexit, through Corona, and then hopefully now reaping the rewards for our clients is a tremendous feeling, but also shapes you. And you always read in the books how tech TMT bubble, I was not part of it as an investor, how people were irrational. The last couple of years have really shown you how ridiculous things very smart people will say or believe in, and you read about it, you don't believe it, half of it, but then you now experience it, and people will tell you that some of these businesses which have now obviously tumbled are great investments at any valuation whatsoever. And you're like, hey, we have to pay too attention to valuation. Paying 200 times revenues, not earnings, revenues is very aggressive. Things can happen. No, this stock will go up. And I think this obviously has been, I think those very bad years and this hiring process at Lingohr, these have been the most influential experiences in my life from an investment perspective.
Yeah, absolutely. That makes a lot of sense. And thank you so much for the session. It was really, really tremendous. And thank you so much for taking the time out of your busy schedule to speak with us today.
Thank you, Itai. All the best.
Thank you.
Good luck.
You as well. Bye-bye.